And just to show you, I've been teaching here 10 years, and value investing wasn't always particularly popular. Right now it is, but let me see if I can get this going. About 6 years ago, we started a website, and we were trying to drum up members for a website called valueinvestorsclub.com. And this is the type of ad we had to take out. Value investing isn't dead. It's alive and well at valueinvestorsclub.com, because when I was teaching here, even at Columbia, and I was spending, in 1999, I was spending a lot of time explaining about value investing and how, buying companies for a price a lot cheaper than what they're worth makes a lot of sense, and this is what we're going to learn how to do and everything else. I spent the whole summer doing that, and then one of my students got up towards the end of the semester to make a presentation and said, forget all that. Forget what Professor Greenblatt said the whole time. Basically, Priceline's going to double in the next 3 weeks. So I'm not sure I was getting through at that time, but now that I think value investing's had a pretty good run, they listen a little closer now. I got started in value investing actually in the late 70s. I read an article in Forbes about Benjamin Graham. And probably coming from Columbia, most of you know Benjamin Graham. The article was about sort of what I considered sort of a secret formula. What caught my eye was he had a formula that said, gee, if you just buy stocks that meet these particular statistics, you can make a lot of money. And of course, I was a student in college then, and if there was a formula to make a lot of money, that was kind of interesting to me. And it got me hooked, really, on figuring out what this was all about. And of course, that was Graham's net formula, and it was a simple formula, just figuring out using balance sheet items. If you could buy a company for less than its liquidation value, that was probably a pretty good bargain. So I found that pretty interesting, and I got a couple of my cohorts in MBA school. Unfortunately, I went to Wharton, and they don't teach any value investing there still. So back in the late 70s, this was probably something pretty new to them anyway. But we actually did a test of Ben Graham's nets, and they don't have. They were called nets, which are stocks selling below their net current asset value. And that was his what he would call his liquidation value. And forgetting the details, it was very hard at that time to get databases that could screen through all these companies to get them. So we actually used these old Standard & Poor's stock guides that came out every month. And there was a list of about 6,000 companies in each little guide, and they had some statistics on them. And actually, me and my cohorts, my MBA cohorts, we actually went month by month through the 5,000 companies in the S&P stock guide for 8 years. As opposed to knowing how to run the computer or having access to the computer. And we manually did this. And then a friend of mine who knew a little about computers that they had at Wharton at that time, something called the DEC 10, the Digital Equipment 10, which was a little bigger than this room, the computer. And it had all the flashing lights and reels and everything. And it sort of, for those of you who remember Lost in Space, that robot, this was less high-tech than that robot, this computer. But anyway, so we got all this data that we had collected over months of writing down prices and, balance sheet items and everything else for these companies. And we actually ran a test showing that just buying these nets, these stocks selling below liquidation value, in fact, you really could do incredibly well. And in fact, Graham used this method for over 30 years for part of his portfolio. And it looks like the mic's working. Okay. So that was very fascinating to me. I think the results were phenomenal. And I was always interested in not working that hard, really. And so if there was a magic formula that really could make me not work too hard and make a lot of money, I thought that was like a great thing. And unfortunately, what happened starting in the early 80s when stocks started to move up, Graham formulated his formula during the Depression era and when people weren't willing to pay a lot for stocks, or at least they thought stocks were a lot riskier and there were bargains. And pretty soon after the boom in the early 80s happened with stocks, most of the net liquidation value bargains that Graham had found didn't exist anymore. So the magic formula was sort of gone. But I did pick up on the fact that value works. In other words, if you can buy something for a lot less than you think it's worth, that makes a lot of sense, and went into the business doing that. And in fact, the studies over the years have showed that value does work over time, whether it's a low price book, low PE, low price to sales, low price to dividend, low price cash flow. Tons of studies over the years have shown that that kind of methodology works really well. But in comes Warren Buffett saying, gee, cheap is really good and cheap works, but what if we could buy good and cheap? In other words, what if we could buy a good company cheaply? And, that made a lot of sense to me. And now the net-nets were gone, I had to come up with some other strategy that was kind of easy. So actually, what we did was we tried to update sort of Graham's magic formula to say, gee, let's put a little Buffett in there and say, what if we just could buy good companies at cheap prices? And what we did was we defined good companies, and we defined good company as companies that could earn a high return on capital. Okay, we used a particularly what we considered a little more sophisticated measure than ROE or ROA. We looked at basically saying, what does a company need to work? To do business, it needs working capital, and it needs fixed assets. And so we said, what is their operating income divided by their working capital and fixed assets? For good, we just said, gee, the company, for cheap, we said, company earns a lot relative to the price we're paying. So you could think of that as the earnings yield or earnings relative to price, the inverse of PE ratio, however you want to think about it. We did a little bit, we looked at pre-tax return and looked at enterprise value, which takes into account the amount of debt that was in there. But so pretty simply, we started studying. We said, gee, how should we weight this? In other words, how important is a company is good, and how much should we weight that a company is cheap? And so we used a very complicated algorithm in the study that we did. And we said, 50-50. So we did that. And really, this is what I've been teaching in class for years, teaching good companies, how do we measure them, and really measuring them by return on capital as measured this way, and cheap, EV to EBIT, generally is what we look for generally when we're looking for cheap. And so I've been teaching it for years, and so it would be nice to know if it actually works. And so we actually ran a test. And what we said was, let's rank all companies. Let's rank all companies based on their cheapness, okay, based on EV to EBIT. And let's rank all companies, so the cheapest would be number 1, and the most expensive number 5,000 or whatever it might be. And then let's rank all companies based on their return on capital. The higher the better. So the highest company would be ranked 1, and the worst company would be ranked, I think we did 3,500 stocks to start, so 3,500. And then we used another complicated formula where we just combined the rankings. So if you were first cheapest and number 250 highest return on capital, so your rating was 251. If you were 20th return on capital and 20th cheapest, then your rank would be 40. And so we combined all the rankings like that and said, gee, what would happen if we did that? So did a little test. I don't know if any of you can see this, but I'll tell you what it says. We tested this over the last 17 years on the top 3,500 companies. And we said, what would happen if you just bought a basket of 30 stocks that ranked the highest, the best combined ranking, the best combination of cheapness and quality of company, return on capital. And these were the results. The first column shows that from 1988 to 2005, the portfolio of 30 stocks, and we held each stock for a year, and we created portfolios every month for those 17 years, and the average return, so it wasn't just a few companies, it was thousands of companies, thousands of picks. So during that 17-year period, the Magic Formula portfolio earned 30.2%. The market average, as equally weighted market average, earned 11.9%. The S&P 500 during that period earned 12%. So those are pretty powerful numbers, and sort of getting back to what I had always hoped to do, which is not work very hard and make money. The other thing we did was we said, well, what are earnings? Are earnings what the projections are going to be a few years out? Because that's actually what we do at my firm, Gotham Capital. We look out a few years to see what a company's going to earn. Then we see what kind of return on capital on a normal basis. And we look at what return on capital would be and how cheap the company is trading relative to those normal earnings. And that's what we do. But of course, there's an art in figuring out what normal earnings will be a few years out. So instead of that, we said, well, people can differ on that. So what we used for this back test was just looking at last 12 months' earnings. What happened last year? Not much dispute about how much the company earned last year. So the results were not using projections at all. They were using just last year's earnings. Nothing you could argue about. So then we said, what? People could argue about this. Hey, it's 3,500 companies. People can push up prices. Maybe you can't really buy them. You're turning over your stocks every year. Maybe there's transaction costs, although I think there's a pretty wide spread. So we said, let's see what would happen if we just looked at the largest 1,000 stocks. We did the same test. And here they also did pretty darn well. These are the 1,000 largest companies. Today that would have market caps over $1 billion, well over $1 billion actually. And the Magic Formula earned 22.8% during the 18 years here, approximately double the market's return. So I think that's pretty powerful. If you can buy large stocks, and you really can't argue about transaction costs or anything like that when you're talking about, very large companies. We did that every month for 18 years, accumulating 30 stock portfolios, holding them for a year, turning them over. It wasn't like a fast turnover thing. We actually tested it if you held the portfolios 2 or 3 years, still worked great, still worked incredibly well. So that's pretty powerful. But then, you could say, well, Graham's bargains disappeared. In other words, when Graham had this formula, then all of a sudden, companies couldn't meet his strict requirements. In this particular case, this was just a ranking formula. In other words, he just took the top 30 companies. But what if, those top 30 companies are sort of aberrational? In other words, what if, some idiot writes a book and explains, how to go do this, and those companies disappear? So we did another test, and we ranked all companies. We took the top 2,500 companies. We broke them into groups of 250 stocks. And with the best combination of the cheapest and the best returns on capital, we put in decile 1, the first decile. Second best, ranked 250, we put in the second. Third best, the third. And this is kind of interesting. The top decile, the top ranked 10%, or 250 stocks, during this is for 17 years through 2004, earned 17.9%. The worst ranked decile earned 2.5%. But the funny thing is, if the first decile beat the second decile beat the third decile beat the fourth decile, etc. So this is kind of neat stuff, because wouldn't it be nice to know ahead of time when you buy stock how it's going to do? I thought that was valuable information. So this kind of says probably the criteria we're looking at are probably fairly valuable, and it's not really just 30 stocks that meet these criteria. It's maybe it's more, maybe this is a good way to look at stocks. Oh yeah, maybe the market's not that efficient, because if you can put stocks in groups ahead of time, into 10 different groups, and they work in order just based on past information, no projections, no nothing. Thought that's pretty powerful. Yeah, I'm going to answer questions later, but go ahead.
Will the company change group from year to year?
Yes, in other words, this was actually putting every month. What we did for the 17 years is we divided the companies into 10 groups and held them for a year. Next month, we divided the companies into 10 groups, held them for a year. So the returns are based on holding the companies, the decile groups, for a year. But they're more robust. It's not that we just did it in January of every year and said these are the returns. We did it in January and held that portfolio to the next January. We did it in February, held that portfolio to the next February. So this is the average of 17 times, I guess, 12 tests. So it's, or 17 times, 190 something 1 year periods of holding 250 stocks in each group. So pretty robust is the bottom line. So this is pretty powerful stuff. And so usually when people do academic studies, which this wasn't, they're usually, this was a study sort of semi-proof of concept, because this is how we invest all the time, just see what happens if we do something really simple. This is what I would call the not trying very hard method, meaning we didn't make projections, we didn't do anything sophisticated. We said, yeah, let's just use last year's earnings. Okay, last year's earnings could be wrong for a lot of reasons, but let's just see how they do anyway, to see if, using our projections, this is a nice way to pick stocks. And so it really just started out as a sort of proof of concept that what we're doing makes sense, effectively. We didn't even try very hard. We used two factors, and these were them. But usually these things are attacked because maybe let's say the data wasn't available at the time you got it. There's something called look-ahead bias, that you're getting this information before you really would have had it at the time. And when we did this test, we used something called the CompuStat point-in-time database, which is just a database that shows exactly what CompuStat's customer, whatever information they had on the date that we tested. So there's really no look-ahead bias. It's the exact data that you could have had at that time, on that day. Then they also claim there's survivorship bias. Usually what happens in databases is if a company goes bankrupt, they just eliminate it all the way back. And so therefore, the companies you're choosing from are sort of above average companies to start with. Here, this was, once again, that special database where it was the exact information that the customers would have. So really, there's really no what's called survivorship bias here. Then they argue, oh, they're small companies. You couldn't really purchase them here. Your transactions costs would kill you and things of that nature. Well, it worked pretty well for the top 1,000 companies in addition to, double the market's return as opposed to, let's say, 2.5 times the return. But that's pretty good. At least it beats an index fund. Same argument about you can't do it after transaction costs. And here, once again, the large companies worked out pretty well. Then the other question would be, some professors say, this Farmer and French study, saying that basically value stocks do better because they're riskier. There's something wrong with those companies. And actually, Farmer and French did a study about 10 years ago showing small cap stocks that are low price to book beat the market. And they beat the market with less risk as measured by usual academics, which is based on volatility. Now, I don't look at risk that way as based on volatility, but these guys did, and actually buying low price to book stocks actually were less volatile. But they said still there's something. The reason you're getting paid more is because these companies are riskier. There's more of these are not good companies. They're selling at low price to book. They're going to go bankrupt. There's bad stuff happening. They're not earning a lot of money. And so there's some risk that we don't measure, even though we use volatility as a measure of risk. There's some risk that we're not measuring that's why they're riskier. Well, in this particular case, we're picking good companies. We're picking companies that are earning high returns on capital. So I think the fact that these companies are riskier, these companies are better, the way I looked at it is, and the way I described in the book is, these are above average companies you're buying at below average prices. Gee, that makes sense. So, so I don't think these companies in themselves, the nature of the business is riskier. Then people get accused of data mining, meaning you run the computer, you try thousands of different combinations of criteria, and you say, eureka, I found the right criteria. In this case, these two factors, first thing we tested, because this is how we invest. So what I wrote up in the book, the little book that beats the market, was exactly the first test that we ever did. So really not much data mine going on. And then knowledge of previous studies. People say that, you knew what all the other studies worked and everything else, and it's true that I know that low PE stocks work and value investing works in general. Never had seen anyone test this particular combination of factors. So that's one reason why we did it. But still, there's a lot of obvious questions, and maybe I'll let you ask some of them. And if you don't ask them, I'll ask them for you. But just to tell you that, Columbia is a special place. Columbia is one of the only schools that has a value investing program. I think to this day, Wharton doesn't teach anything about value investing. With data like this, it's pretty powerful that markets aren't quite efficient, that particularly value investing works quite well. But still, most really smart people, a lot of academics don't still buy this. I was actually reading an obscure, because I'm an exciting guy, I was reading an obscure quantitative finance journal from Britain, and they were interviewing Paul Samuelson, the Nobel Prize-winning economist who probably wrote most of the textbooks that you used in your first economics class. And they were interviewing him because he wrote one of the seminal papers on the efficient market over 40 years ago, and they were interviewing him on that anniversary, the 40th anniversary. And they said to him, the idea that all relevant information is priced in gives rise to the joke about two economists walking down Wall Street who spot a $100 bill. That's the old story that everyone knows. One says to the other, don't bother picking it up, because if it's a real bill, someone already would have taken it up. So Samuelson's response to this was the questioner asking him, this is the old story and you still believe in efficient markets. He says, by the way, that would be very good advice at an economist convention. But I tell you, at a Rotary Club convention, leave it out, because I think many of them are too dumb to even lace their shoes. So he's not only saying, obviously, that markets are efficient, but that most people are too dumb to realize that they are. Me personally, I'm going to keep bending down and picking up the $100 bills. But I think it teaches a lesson that, if you're willing to do some work, value investing works and it's worth your time. So that's one lesson. I think the other lesson is, if you're ever interviewed by an obscure British quantitative journal, be careful of what you say. But anyway, why don't I take some questions, because there are probably some obvious questions here, because this looks too easy, right?
Why don't you look at it on an after-tax basis? Like another cost to the business.
Well, we look at it at a pre-tax, pre-interest basis, because to put all companies on the same scale, there are different tax rates. In other words, when I look at a company, I want to know, what are the assets necessary to generate the profits, and what were those profits? People have different, companies have different tax rates, and this puts all companies at an equal level.
As an equity holder, you're getting an after-tax return.
Right. Well, that's one thing you could look at. But if you want to look at as an acquirer, you would generally look at the business on a pre-tax basis. And so this was one simple way to equate companies of that nature. Also, if you include taxes, then you have to look at interest. People have different interest rates, different debt structures. And this puts everything on a pre-tax, it doesn't matter how that you financed your firm. This puts everyone on an equal footing. So it's just a simpler way to compare companies with all different tax rates and all different leverage ratios.
With all the horsepower devoted to quantitative investing, why do you think an anomaly this huge hasn't been identified and squeezed out of the market?
That's a great question. I think the answer really is that the great thing about this magic formula is that it's not that great. It doesn't always work. There are actually, during the 17 years, even though if you look over 17 or 18 years, the returns are pretty phenomenal. This is pretty obvious. It works very well. But there are 1, 2, and even sometimes 3-year periods where this doesn't work. I told 2 stories in the book. One about a guy who wrote another book testing, 40 different formulas over the last 40 years, what would work. And that was really a data mining experiment, but, which criteria would work. And so this guy writes a book, and it was a great book, and starts a mutual fund based on the best, sort of the winning combination of factors that he used. And what was interesting is that during the first 3 years that he ran it, the formula did really badly. And the mutual fund didn't attract many investors, and actually the guy who did the study, the guy who wrote the book, actually sort of gave up and sold his mutual fund company. And of course, what happened over the next 6 years was that the mutual fund, following the same exact quantitative criteria that had been used when it wasn't doing well, blew the doors out, and since inception, it's done incredibly well. I also had the privilege of backing a friend of mine into business a little over 10 years ago, and he was the smartest guy I know. I knew on Wall Street. Actually was one of my co-authors of the study we did on the Ben Graham stuff originally, and so I'd known him for a long time. I knew he was the smartest guy I knew, and so I thought this was a no-brainer. I'm going to back him into business. And he set up a business running institutional money. And during his first 3.5 years, he did terribly. This was in the late 90s. People weren't interested in value. There were a lot of crazy stuff going on in the market. I remember having a lunch with him, and he said, look, what I'm doing makes a lot of sense to me, and I'm going to keep doing it. And I agreed with him. And I said, no, you got to keep doing it. Everything you're doing makes sense. It's very smart. Unfortunately, none of his clients agreed with him. They thought he was an idiot, and they pulled out, almost all of his money. But he managed to hang on. Today, 6 years later, he's running $20 billion. Since inception, he's in the top 1%, even the high end of 1% of large institutional managers, just following the same study. So the point is, it works, but it doesn't always work. It's hard to do. And even if you're a professional investment manager and you believe it works, and you don't do well for a couple of years, your clients usually walk out the door. So in practice, it's actually very hard to do, and most people end up trying to do well over the short term. And this is a very lumpy way to make good money. So the important thing, and I spend a lot of time in the book explaining this to people. Hopefully my class gets me every week, and I sort of bang it into their head, after a semester. But if you're reading a book, the bottom line is I just say what you have to believe is what you're doing makes sense. And that's why I really put it in terms of buying above average companies at below average prices. I give a promise to my students every semester. I say, if you do good work and you can value a company well, in other words, and your analysis is correct, the market will usually agree with you, but sometimes it can take 2 or 3 years. Mr. Market's pretty crazy in the short term, but over 2 or 3 years, usually, if you get your analysis right, the market will agree with you. And that's sort of the perspective that I have them walking out with, and that was sort of what I tried to convey in the book.
Can you go back a slide just to see the time sequence, how lumpy it is?
Well, this is, I'm going the wrong way, aren't I? I actually set up a website called magicformulainvesting.com, and it does all this stuff for you. Because when I finished writing the book, I really wrote it so that my kids could understand it, at least the ones already in 6th grade. I had written another book about 10 years ago, and I thought I had made it so accessible and easy for everyone to do, but I hadn't started teaching MBAs yet, and then realized that, gee, I sort of wrote this book on an MBA level, and I didn't realize that until I started teaching MBAs. So this book, I went the opposite direction, and I tried to explain all this that I'm telling you in terms that my kids could understand, and I tested it out on them and nephews and nieces and everybody else, and even my wife, which is probably a tougher sell, and she understood that. So that was the goal of this book, and so to make it even easier for everyone, I just set up a website, magicformulainvesting.com, and it actually will give you a list. You put in the market cap size and that you're interested in, it'll give you a list of top ranked companies at that time. Let me go. All right. So on a calendar basis, this particular top 30 stocks, this one would stand out. Even though the market was down 22%, this thing was down 25%. In 2002, not too many professional managers can take the heat of doing that. Not just underperforming, but doing well. But on average, it did earn 22.8%. It did it. Another statistic that's kind of interesting is that over 1-year periods, it beat the market 60% of the time. Over 2-year periods tested, and we did rolling 2-year periods, beat the market, I think, 3 out of 4 of those 2-year periods. Actually, 5 out of 6. And then over 3-year periods, for the small caps, actually, every 3-year period that we tested, rolling periods, there were 169 of them during the 17 years of the study. It actually did beat the market 169 out of 169 times. So that's pretty good. On the large caps, it beat it over 90% of the time. Yes?
Does the inverse work on the short side? Like if you just flip this around and short the, you know?
All right, so in other words, take decile 1 and buy it and short decile 10,
Yeah, I mean,
and then you got a smooth sailing. Well, you know, there's a lot of hedge fund managers out there that have a long-short strategy, depending on what it is. And, you know, if you're doing valuation shorting as opposed to special situation shorting, which would be, oh, the company's going to run out of money or it's going to go bankrupt or something like that. But if you're just doing valuation shorting, that's sort of the, you know, market neutral, let's say, investing. It's sort of, I call that sort of I got it, I ain't got it strategy, which means it works great for 5 or 6 years and then it blows up on you. You know, like look at 1999 or 98, where companies that earn no money and have no future, you know, are trading, you know, hugely well, and then companies that are earning a lot of money with great solid businesses, no one wants to own them. That happens every once in a while. If you did this, you'd increase volatility significantly. If you bought decile 1 and shorted decile 10, it looks like you can make 15% with market neutral. But actually, it's a lot more volatile than just buying the longs. So, and that tends to happen in general, and I think that's a flaw in many long-short strategies. I mean, you can match, you can do it effectively, but it's not such a simple thing. You have to match industries and everything else. Who didn't ask it?
You know, in terms of the formula you used, you know, how often did you reset it? Every year, every 3 months when the financials come out, and you know, did that make a difference?
Well, what I said was, you know, we'd pick a group of stocks and hold them for a year, based on the formula. But if you held them for 2 or 3 years, they worked great too. I guess that's one way to answer. But we set the formula. The formula never changed, but we did the formula. We picked stocks and held them for a year, whether we did a decile or whether we bought the top 30 ranked. Yes?
It's clear that your 17-year track record on the magic formula achieved 22%. But what were you doing? What else were you doing at Gotham Capital so that you were able to achieve a 40% return over 20 years?
How do we make 40% over 20 years? Yeah, we had to work. That whole thing about not working that hard can get you only so far. You know, I would say, I mean, we didn't do this over that. We used these principles to invest over that time. But there are 2 ways you can get very high rates of return, I think. One is not to run a lot of capital. In other words, we returned our capital several times during the, you know, we returned part of our capital, and then we returned all of our capital over 10 years ago and just ran our own money for part of that period. So that not running a lot of money, so that you can put your money into your best ideas. And the other is we're very concentrated investors. Generally 5 to 8 positions are generally 80+% of our portfolio. So when we're figuring out what a company's worth, what normalized earnings are a few years out, and that we're buying it cheap and it gets good returns on capital, we are hoping that we're right, because we only own 5 or 8 companies. And you can miss, you know, we've made plenty of mistakes over the years, but on average, majority of the time, we wait till we feel high confidence, and that's how we do that. So I think the only way to achieve those kind of returns is really stay small and concentrated. And so I think that, you know, we're picking the best of the best of the best, and only when we're very certain about them. And we still blow it sometimes, but, you know, on average, it's worked out pretty well. Yes?
Does the magic formula work better if you're using forward-looking forecasts with LTM? So if you use like Wall Street consensus?
You know, we've done a lot of research beyond the first thing we tried, you know, the not trying very hard method. And I thought this worked really well, and so this is what sort of we were willing to share. You know, it depends whose estimates you're using, I guess, would be the answer. If you're using really bad ones, they don't work.
Did you go back 17 years because that's the amount of available data that you had?
Yeah, this point-in-time database that CompuStat had only went back that far. That's a good question. That's why we went that far. It would have been nice to go back further, but there's so many data problems when you use other databases and other things. This was, and a combination, this was the simplest to do, and you know, it was very robust throughout the period. Didn't matter which period you chose, and you know, as long as it was long enough, 5 years, 6 years, and you know, the deciles worked pretty darn well. It was very powerful. That's why I keep leaving this slide up. So, we felt pretty confident about it. But no, we didn't go back earlier, and that's because the special database we used, the ones we had confidence in, didn't go back any further.
Because you really have one bear market in there that was really specific to a certain group of stocks. I mean, are you at all concerned that if you were in another bear market that might affect, large cap companies other than tech stocks, it might adversely affect the results?
Well, tech stocks got hurt, but the S&P 500 halved, since 2000. 2000 to 2003, it halved, so that's kind of a bad bear market. 1990 was kind of a pretty bad bear market. I would say I'm not concerned. I mean, every study that's ever been done, value works. I mean, even simple low PE investing works. It works across every, this was tested not by us, but in every country, or not every country, but 6 or 8 other countries with large stock exchanges back testing with whatever errors there are, but it seemed to work incredibly well, in all the studies that I've read that have been done subsequent to the book. So it seems like buying a good company, if you can get it really cheap, just makes sense to me. I mean, my confidence is not on the back test going forward. My confidence is that what I'm doing makes a lot of sense. It happens to do well in the back test. So it shows how powerful it is, and it shows how powerful it is when I'm just using last year's earnings, stuff everyone has. So I would say we did this as a proof of concept, so I could convince next year's students that, hey, I'm teaching you good stuff. So, yeah.
If you went back to the Gotham approach and had a much more concentrated, so it's not a top decile, but it's the top 2%, are returns significantly better or no?
The difference between what we do at Gotham and what this simple back test was is that we do not use last year's earnings. What we use is normalized earnings 3 or 4 years out, okay? And that's what you'd really want to use theoretically, okay? Because you can think of all the flaws in using last year's earnings. Could be aberrational for any number of reasons. The stocks that are cheapest are probably the ugliest looking ones, short term. Maybe they won't compare well to last year. So to put this in context this was sort of done as a proof of concept. Look how powerful this is when you're not even trying very hard. And what we do at Gotham is we're using our projections. If we get those right, normalize, and we can't do it for a lot of companies. That's why we run a concentrated. We're lazy, and we can't do it for a lot of companies. So for the companies that we have high confidence in and that we can buy cheap and are getting high returns on capital, we feel very good about them because of studies like this. But that's the way we do it. We're using our normalized earnings. There's the little art in there. But as Warren Buffett says, sticking to your circle of competence, meaning, only do the stuff that you can kind of do kind of easily or that makes a lot of sense to you. That's not, I tell the students, you're going to take in jobs that maybe you don't have that luxury of just working on companies that you feel high confidence in. Usually I tell them if you can't figure it out, just what do you do when it's very complicated, the future's not very clear? How do you make projections? So I don't know, just throw that out. You probably can't make a good projection if you don't understand the business or know how the industry's doing. Sometimes if you're an investment banker, you still have to try to figure it out. Just doesn't mean your answer is very good. Yeah.
So after you've run a slew of companies through the magic formula and you have a universe of third, what gets you to high confidence? Is it more qualitative analysis, or does it come down to how do you feel about management and strategies?
Oh, you mean if I'm picking and choosing from that group?
To get to the 5 to 8 companies.
Right. I don't necessarily pick from that group. I pick from a group of companies that I can make projections on. This may be a good idea generator, and we would look at this list to generate ideas, and they're actually, through happenstance or other, we own a number of companies that rank very, very highly, according to the magic formula. But not to confuse the two, okay? My other book 10 years ago was a book about value and special situation investing, which is how to find cheap companies going through extraordinary changes, spin-offs or recapitalizations or restructurings or, stuff any kindergartner could figure out. No, basically, but I did write it thinking that, everyone will read this stuff, and I don't know what I was thinking. Bottom line is when something's complicated or confusing or whatever, it's obviously a pretty interesting place to go look. And if you can do your valuation work, then you use your value investing skills. Try to figure out what a company's worth and pay a lot less. But if you look in places, these little nooks and crannies that are complicated that other people aren't looking at, you have a better chance of finding these bargains. And so that's what that was about. So part of what we do at Gotham Capital is that kind of investing, sort of sleuthing around, finding these things that are so easy that if anyone else had done the work, they would have thought it was cheap too. But they didn't. We did. We read through the 400-page prospectus and, figured out some stuff. The other part we do is just straight value investing, which is closer to this. And the idea of this, once again, was really, gee, this is a good strategy, long term. Most people would quit doing this unless they really understand in their bones what you're doing. And what you're doing is, once again, on average, because that's why I said buy 30 companies for people who aren't doing any work. You want to just get the average. It's much better than an index fund. You're getting an average of companies that on average are above average and available at cheap prices. A lot of them won't work out. They're not good companies, but on average, you'll do very, very well. Who didn't?
Can you talk a little bit about risk management and how that plays into your degree of confidence in terms of the returns of these companies?
Repeat the question.
I guess can you talk a little bit about more specifically how you do measure risk and whether that impacts your degree of confidence in terms of the expected performance of the companies in Gotham or in the metric fund?
Okay. It's a great question, too. How do we measure risk if we're not using short-term volatility to figure out how risky something is? We sort of view risk as losing money. And so we don't like to lose money. And the question is, over how long a period are you willing to look at that? One measure we did during the study, for instance, would be, and obviously they're not independent periods, but we had 169 rolling 3-year periods. And the worst 3-year period, in other words, so if you bought in February 1992 through February 1995, how did you do? In other words, if you could hang out with this strategy for 3 years, how did you do? Now, the worst return for the market, the worst 3-year return for the market was down 45%. During the study we did. Our worst return following the formula was plus 20%. So even though, however you measure volatilities, I would say, gee, I didn't lose money during 169 of 169 periods made money. That wasn't true. Only, 80% of the periods made money, 3-year periods made money for the market, let's say. So, gee, that's a lot better. My worst loss, if I follow this over a long period of time, was making nice money. The worst loss was losing almost half my capital, just playing the market for that period of time, just market index. So that would be one measure. I mean, in Gotham Capital, the way we also look at losing money. In other words, we've had a very volatile portfolio, but if you look over calendar periods, we've never had a year that we lost more than 5%. And so to me, that's tolerable risk. I wouldn't necessarily want to be down 30% a year, although there have been 3 or 4 month periods where we've been down more than 20-something percent. It's just that when you're playing value stocks, usually when you get hit that badly because the market's bad or something like that, those stocks are so cheap to begin with, they bounce back pretty quickly. So even looking at calendar periods, we never really had that bad period. But you have to be willing to do that. I mean, Buffett says you have to buy a stock and be willing for Mr. Market to go crazy and you be down 50% at one point. You just have to be right on your analysis. And I still believe what I tell my students, which is if you wait around 2 or 3 years, the market will get it right. And that's generally been my experience, and statistically that's also seemed to work out pretty close to correct. Over any 1-year period, anything can happen, or over a few months. And I think we've had ample experience of that. In the late 90s, early 2000, market was crazy. I mean, it was literally crazy. And you have all these smart people and you have all these trillions of dollars chasing, and how come the market's not efficient? Well, the market was just crazy in the last few years. In 2002, end of 2002, beginning of 2003, there are huge bargains all over the place. So for those people who say, there's so much money chasing these things, the market's so efficient now, everything else, I say the market will continue to be volatile and there'll be plenty of opportunities for those people who continue to look, and that's sort of what I tell my students. Yeah.
Are you looking purely at rankings and trying to stay 100% in equities, or are you also looking at macroeconomic factors and deciding of what proportion of your portfolio is in equities or some other kind of assets?
It's a good question. It's really just a question for us, not for anybody else, or an answer for everybody else. We look at equities as valuing, our investing as valuing companies and paying a lot less for them. Okay? If we have an opportunity to do that, that's been our best place for our money. Because if we think we're good at valuing companies, there's a big opportunity to do that. We don't really look at macro factors. We will look if, most of our portfolios, let's say in retail companies or, consumers going to drop dead, what's going to happen, how are we going to be affected? I don't think we do much about it, but we do look at that. We're not very good at projecting macro factors. We try very hard not to pay any attention to those. And once again, we're looking out 3-4 years. In other words, I think part of the benefit, and I think Bill Miller would say something like this, that we're sort of playing the arbitrage between people looking at the short term, the next year or two, and us looking out 3 or 4 years to value. And you make a lot of money by taking a longer term horizon on your investments. Hopefully it works out in the next year or two. And, but if you're willing to hang out for 3 or 4 years and sort of project through whatever short-term problems a company has, that would go for the economy also. Which is a way of making my answer relevant to your question. Yeah?
If you look back 3 or 4 years and you try to see how accurate your projections were back then, 3 or 4 years forward, i.e. today, are they pretty close?
If what?
If you go back in time and look at your 3 or 4 year projections and see how they were versus the actual numbers that came out 3 or 4 years later, are you pretty close to getting those right?
We get them right in broad. Usually we'll get them right in broad brushstrokes. In other words, we would be buying a company at 45 that we think today is worth 50% more, high 60s and growing over, 3-4 years out. So, so if you look at that, if we're wrong, on our projection, but, it's only worth 65 in 2 years, we still did pretty well. Theoretically, the way we projected it should have been worth 80, but we're at 65 in 2-3 years. We leave ourselves enough room to be wrong on those, but we want to get the direction and the general sense of it correct. And so that's all we're holding ourselves to. Do we think it'll be somewhere in this range? So.
You meant earnings projections. Project your earnings.
Yeah, project our earnings, sorry. So in other words, we're projecting our earnings, and therefore it should trade at X multiple of those earnings a few years out. So that would come out with a valuation on those earnings, 3-4 years out. And if we miss those earnings projections because we were too high, but we don't miss by tons, we left ourselves so much room when we bought it, such a margin of safety, that that's the way we tend to invest. We're not looking at how accurate we are. We're looking at whether we're in the ballpark.
When you're projecting out your normalized earnings, do you find that you're typically looking at companies that maybe are below their normalized operating margin for some reason, and your assumptions can just get them back to normalized operating margins a few years out to get them to the normalized earnings number, generally speaking?
We're usually not that smart. To give you an example, that's one way we could do it. I mean, that's a reasonable question. But, just a few years back, we bought a company called Foot Locker. Okay, the stock was at $10. It was earning $1. Very cheap. It looked like it had sort of built out its franchise across the U.S., not a lot of room for growth. But we thought there was some growth in there. And so it was cheap just on that basis. But it turned out they had some superstores that weren't doing very well, and losing them 50 cents a share. If you went through all their superstores, they were actually losing 50 cents a share. So, and those superstores were coming off lease in the next 2-3 years. So that effectively, 2-3 years out, our base really is $1.50 because they were earning $1 but losing 50 cents in those stores that they were going to be closing. So without doing anything else, now we own a $10 stock that's got $1.50 in earning power and growing. Maybe not that fast, and growing. And that was sort of our projection, saying, gee, at $10, that's a good bet. And I would say that's closer to what we do than having to do anything hard.
How did you know that they were going to sell off or get rid of those leases in 2 to 3 years?
Called management just to discuss what they thought was going on, and they said, well, our superstores are losing a ton of money, and our leases are coming off over the next 2-3 years. Oh, they could change plans, but they're not going to be stupid. So in other words, they could either turn those stores around, but they're coming off lease. So you have a free choice to get out. Obviously, we also made an assessment of management, how they were incented, and that they were rational human beings. Who hasn't? I think I only have time for one or two more.
Yeah, actually, I have two questions. First one, when you look at the data, you look at the normalized data, or you just look at snapshot of the current period. That's one. The second one is when you actually put the money in work following the magic formula, how frequent do you put the money in? For example, the list fluctuate. Every day they have new ones coming and existing ones go out. So how frequent should you adjust the portfolio? And also, what do you do when the company you buy today and it's getting out of the list tomorrow or next week? What do you do with those companies? So
Okay, I forgot the first one, but the second one, I'll get back to it. But let me answer the second one, then maybe we can double back. How's that? The answer is we have this Magic Formula Investing website, and it spits out a bunch of companies, and they're always changing. So what do I do? And the answer is that what we did in the study, anyway, was we bought a company when it showed up on the list on the day we tested, and we held it for a year. So that's it. If it falls off the list the next day, we still held it for a year. Like I'm telling you, I didn't write in the book, but holding them for 2 or 3 years also did very, very well. So you don't have to turn it over every year. I just suggested that as a simple thing for people to do that could maximize taxes, because any losses you could take short term and gains long term. What was the first question? Or let someone else ask one more question, and then maybe who didn't ask?
Are there any particular sectors in which there's a preponderance of high-rated companies?
We haven't studied that closely, but brand name companies would come in there, service companies would come in there, because we're ranking return on capital. So in other words, you don't want big capital-intensive businesses. And so, but I think the principles of, even if you're a manufacturer, you don't want to have to be getting 10% pre-tax returns on capital you'd rather be in a business that pays you more or earns you more. And, the good thing about companies that earn a high return on capital, and I explain this in the book, but, there's good things about these. It means, like, if you have a chain of stores and you're earning 50% pre-tax returns on capital, probably a good indicator of maybe you have a chance to reinvest that money, and that's really why you're looking at it at a high rate of return, because your stores are earning a lot of money. So if you open another store, your incremental return might be very high. You're more likely to have high growth rate in earnings, because if you can invest your money at high rates of return, most people can't do that. Most people can invest their money at average rates of return. So if you're in a business that you can reinvest money at a high rate of return, you're going to have a higher rate of earnings growth. And the other thing about companies that earn a high return on capital is that they're more likely to have some kind of barrier to entry, because most businesses that have been around for a while, if they don't have barriers to entry, earn average returns on capital. So bad businesses never earn a high return on capital. So other than, let's say, cyclically peaking companies, companies that earn a high return on capital, on average, if you buy a whole bunch of them, will have some attributes which make their ability to earn above average return on capital good. And the question is, well, don't people attack companies that make high returns on capital, and aren't those always under attack and capital returns coming back? And my answer to that would really be that yes, some companies can maintain it. Some companies that earn high returns on capital are under attack often. But I would suggest that generally the whole expression reversion to the mean the way I look at it is reversion toward the mean. In other words, if you're in a good company, you can be going toward the mean but not hit the mean. And if you're buying that at a low valuation, in other words, a very below average price, and it stays above average, even if it doesn't stay as high as it is now, you still end up owning a portfolio of good companies at below average prices. So I think it remains pretty powerful. Anyway, if you haven't read it yet, the little book that beats the market. And thank you very much.